The global financial system runs on two fundamental laws: physics and psychology. Physics dictates that assets require energy and structure. Psychology dictates the collective belief that assigns them value. When the psychology breaks, the system shatters with a speed that defies comprehension. The headlines were sensational, designed to incite immediate fear. 970 million vanished overnight. Inside, Bitcoin's massive price-free fall that crushed the crypto market. Bitcoin, having soared weeks earlier to a stunning all-time high above $125,000, suddenly plunged back into the low 90s. It was a severe price crash, marking a 25% decrease over just 6 weeks. For the casual observer, this was a clear signal of failure. A bubble popping, the inevitable end of a speculative mania. But financial history teaches us that the greatest acts of financial destruction are never accidental. They are engineered, exploited, and amplified by structural flaws built into the system itself. This documentary provides a deep forensic audit of the October 2025 market event. We will prove that Bitcoin's crash was no accident. It was the largest notional deleveraging event in crypto history, catalyzed by a geopolitical shock and amplified by critical failures in market microstructure. The total forced closure of leveraged positions exceeded an astonishing $19 billion in liquidations within 24 hours, erasing over $1 trillion in total market capitalization. We will break down why the price fell, who was selling, what broke in the underlying architecture, and most importantly, what comes next for the asset that continues to defy conventional economic gravity. The collapse began not with a fundamental flaw in Bitcoin's code, but with a shock originating entirely outside the digital ecosystem. The event served as a brutal reminder that digital money remains inextricably linked to physical geopolitics and centralized political power. The entire market structure changed on October 10th. Bitcoin, which had recently surged to a new record high of just over $126,000, reacted violently. The synchronized response provides definitive evidence regarding Bitcoin's prevailing asset classification. Despite persistent narratives attempting to position Bitcoin as a safe haven akin to gold, the reaction to the tariff threat aligned perfectly with the volatility seen in traditional equities during a trigger event. The simultaneous slump demonstrates that Bitcoin functions as a highly correlated high beta risk asset, strongly tethered to global macro sentiment and geopolitical instability. Institutional risk models must, therefore, treat large BTC exposure as highly correlated to growth-oriented speculative assets, rather than as a hedge against systemic fiat currency failure. The sensational title, Bitcoin-S Crash Was No Accident, is supported by credible forensic analysis indicating deliberate exploitation of information asymmetry. Precision trading occurred minutes before the public tariff announcement. This failure in market fairness severely erodes institutional confidence in the integrity of the digital asset markets. Anatomy of the precision. Short. On-chain analysis details the meticulous timing and scale of a massive short position. A major trader successfully placed a short position estimated between $735 million and $1.1 billion just half an hour before President Trump arrests public announcement regarding the new China tariffs. Hyper-accurate timing. Specific data illustrates the degree of precision involved. An account funded with $80 million opened a short position totaling approximately $400 million. Crucially, the account ceased all shorting operations precisely 1 minute before the official 2050 UTC announcement. This hyper-accurate timing strongly suggests prior knowledge or exploitation of a privileged information channel regarding the impending geopolitical event. The profit. As the market tumbled immediately following the announcement, this calculated trade yielded a significant profit, estimated to be between $80 million and $88 million. The alleged perpetrator. On-chain detectives identified the address as likely belonging to Hong Kong businessman Garrett Jin, also referred to as Garrett Bullish, the former CEO of the now-defunct crypto exchange Bitforex. Jin publicly denied insider trading allegations, claiming the massive trade was based on economic analysis and risk alerts, and that the funds belonged to his clients. The existence of such precision shorting confirms that the crisis was initiated not by organic fear, but by the calculated exploitation of a known political event using insider knowledge to trigger the catastrophic chain reaction. The true scale of the disaster was the subsequent massive forced unwinding of leveraged positions, amplified by structural flaws in the crypto exchange ecosystem. The market event of October 10 at 12, 2025, represented the largest notional deleveraging event in crypto history. The geopolitical shock triggered margin calls, forcing the initial wave of selling. Investors who used leverage, borrowing money, often 50% or more to increase their trading size, were the first to be wiped out. The margin trap. Investors with not a lot of cash read advice suggesting they use leverage, borrowing against their $10,000 Bitcoin position at 50%. When the price comes down, the margin is breached. The exchange automatically liquidates the position, a process known as auto trading. The sensational number. This automatic liquidation mechanism was responsible for the infamous headline number. In the 2 trading days following the shock, $917 million in Bitcoin was sold on liquidation auto trades. This number, while shocking, fundamentally misrepresents the true scale of the crisis, which was nearly 20 times larger. The $917 million was just one domino in the far larger cascade. The total forced closure of leveraged positions exceeded $19 billion. This massive volume overwhelmed the market structure, exposing severe flaws, particularly the use of auto-deleveraging ADL systems. ADL S-roll. ADL is a mechanism used by centralized exchanges, CEFI, to manage risk when losses exceed the exchange, S insurance fund. It automatically reduces the leverage of profitable counterparties to cover the losses of liquidated traders. Market disruption. When liquidations become this large, it's not just retail traders losing money. Market makers, the firms that provide liquidity and stabilize volatility, get blindsided. When their hedges are liquidated, they pull back, shrink their inventory, and quote smaller sizes. This withdrawal leaves gaping holes in the market structure. The malfunction. Exchanges like Binance experienced massive forced liquidation clusters. One CEO publicly stated that Binance AS-ADL system malfunctioned and hit them with fills that make no sense. The failure of market microstructure, specifically the ADL systems, massively amplified the crisis. The systemic failure led directly to the collapse of regulated entities that were supposedly delta neutral, designed not to lose money. Stream Finance. Example, the collapse of Stream Finance, a $200 million delta neutral fund, which lost around $93 million and went bankrupt, illustrates this risk. Their hedges were caught in the same ADL chain reaction, proving that even sophisticated funds could not ride out the structural shock. Historical echoes. This chain reaction of leveraged collapse echoes historical bubbles built on cheap credit and blind faith. In 1929, Americans bought stocks on 90% margin. When confidence cracked, the panic selling wiped out billions, shattering trust and plunging the world into the Great Depression. The lesson is the same. Leverage magnifies both gains and losses, and when the illusion of safety breaks, the destruction is proportional to the leverage in the system. The structural fragility exposed by the $19 billion cascade was not uniformly distributed. It was most brutal in areas lacking liquidity, particularly the altcoin sector and assets tied directly to the centralized exchanges. The structural fragility confirmed that liquidity depth, or lack thereof, was the primary risk differentiator during the cascade. The disparity. While Bitcoin AS decline was relatively controlled, falling 6.84% intraday, the altcoin sector experienced an exponential collapse due to extremely thin order books. The disparity between the flagship cryptocurrency and smaller tokens was staggering. Bitcoin dropped 7%, while altcoins experienced drops ranging from 20% to 27%. Catastrophic drawdowns. Tokens like AAVE, AVAX, and Doge suffered catastrophic maximum drawdowns of approximately 70% within minutes. Volatility metrics confirmed the severity. Bitcoin's 5-minute rolling volatility spiked 20 times the daily average, but altcoin volatility exploded by 25 times. The verdict. These were not organic price movements. They were mechanical liquidations, overwhelming sparse order books, causing price impact to amplify exponentially. This conclusively demonstrates the liquidity tiering trap. Liquidity risk far outweighs token utility or narrative during stress events. Institutional portfolio construction must apply a severe illiquidity discount to altcoins, acknowledging that exiting large positions during systemic pressure is functionally impossible without triggering massive catastrophic price impact. The system's most dangerous vulnerability was exposed through the catastrophic failure of exchange peg day, or wrapped assets listed on centralized trading platforms, most notably Binance. The failure point. Assets generated or wrapped by a centralized exchange introduce critical counterparty risk inherently tied to the exchange as solvency and specific governance. These assets proved fundamentally fragile under severe market stress. Violent depegging. 3 specific assets, USDE, WBETH, wrapped beacon ETH, and BANSOL, Binance staked SOL, depegged violently. USDE, intended to trade 1.1 with the US dollar, plunged to as low as 0.65 on the Binance venue, a 35% depeg. Even more severe were the failures of wrapped staking tokens. WBETH bottomed near 430, and BNSOL bottomed near 34.90, representing catastrophic discounts of 80% to 90% relative to their underlying assets, ETH and SOL. The silver lining, stablecoins. It is critical to note that while exchange-pegged assets failed catastrophically, properly backed stablecoins maintained their functionality and acted as designed. The problem was not the stability of the dollar-denominated unit itself, but rather the operational environment in which these units were traded and utilized as margin collateral. The failure was in the exchange operational stack, not the stablecoin issuance itself. Beyond the immediate structural failures, the crash was sustained by persistent macroeconomic uncertainty and the presence of a persistent mandated seller. The market environment in late 2025 remained characterized by risk aversion. The crypto market slump mirrors declines in tech stocks and other risk-sensitive assets. High beta asset. This confirms Bitcoin's continued sensitivity to macroeconomic worries. The market remains highly sensitive to macro data and the Federal Reserve's signals, reflecting its current status as a growth asset rather than a reliable macro hedge. Interest rate pressure. Bitcoin historically performs best when interest rates are low. Higher interest rates mean that investors can get higher rates on cash without having to go to riskier things like Bitcoin to get their return, making high-risk assets less appealing. The shrinking likelihood of aggressive interest rate cuts has introduced significant uncertainty, impacting BTC's price and dealing a blow to the momentum-driven rally observed earlier in the year. The price action following the initial shock was unnatural, suggesting a mandated closure of positions. The 9:30 a.m. dump. For almost 2 weeks straight, someone was selling Bitcoin every single morning at 9:30 a.m. Eastern Time, the exact moment the U.S. stock market opens. This precise, repetitive timing suggests a mandated seller, likely a fund that is unwinding or a market maker that is de-risking their portfolio, forced to close a position. This is not retail panic. ETF outflows. This persistent selling pressure was reinforced by institutional capital retreat. In November 2025, Bitcoin exchange-traded funds, ETFs, experienced $3.5 billion in net outflows, marking the largest monthly outflow to date. This signal of institutional retreat removes a significant price floor. Historical echoes, the silent tax. The process of financial cleansing during crashes, where losses flow downward and capital is extracted upward, is a constant theme in financial history. Just as the bailouts of 2008 ensured that the banks, creditors, survived while families, debtors, lost homes, the market mechanism here forces the most vulnerable, leveraged retail and thin altcoins, to pay the bill for the system's structural defects. This is the financial historian's verdict. The game has always been rigged for those who understand how money truly works, holding capital, liquidity, and information. Despite the chaos and structural flaws that amplified the crash, long-term proponents argue that the fundamentals of Bitcoin have actually never looked better. The volatility reflects short-run risk-taking psychology, not a fundamental failure of the asset. Michael Saylor and other long-term investors emphasize that Bitcoin is not a short-term trade. It is a long-term asset that requires discipline. Volatility is normal. Over 5 years, Bitcoin has had 6 brutal drawdowns. If you want to ride the rocket, you have to be prepared to pull the G's. The long-term perspective shows that even falling from $125,000 to $94,000 is still a massive gain from previous years. The minimum horizon, if you're going to buy Bitcoin, you need a 4-year time horizon at least. It's almost like buying a house. If you buy a house for 3 months, it's a bad investment. If you buy it for 5 to 10 years, you should be fine. Bitcoin should be looked at the same way. The structural shift toward institutional adoption is undeniable and provides a powerful counter-narrative to the crash. The ETF pipeline, the launch of spot Bitcoin ETFs, created permanent pipelines from traditional financial institutions into Bitcoin. This includes slow money from pensions, endowments, and insurance companies. This boring money is the exact opposite of the leverage traders that blew up on 10 to 10. Collateral acceptance. Bitcoin has crossed the line from being just an asset for speculation to actually being an asset you can borrow against. JP Morgan, one of the largest banks in the world, is now accepting Bitcoin as collateral for institutional loans. Once Wall Street starts accepting something as collateral, it enters the credit system, and demand becomes structural, not cyclical. Regulatory milestone. The FHFA, which regulates Fannie Mae and Freddie Mac, announced this year that mortgage underwriters are allowed to consider Bitcoin holdings when evaluating a borrower's financial strength. This is a massive regulatory shift. Bitcoin went from being a fringe internal asset to something that helps you qualify for a mortgage. Cold storage disappearance. When institutions buy Bitcoin and custody it with regulated firms, Fidelity, Citi, Standard Chartered, those coins effectively disappear from the liquid float for years. They are locked away in deep, dark, cold storage, removing supply from the immediate market noise. When stacking up all this institutional adoption and regulatory movement against the price dropping 35%, it becomes obvious what is happening. This is exactly the kind of setup that long-term investors wait for when the weighing machine is delayed by flows. The market is currently undergoing a structural reset driven by deleveraging and regulatory reaction. The path forward is defined by technical support, legislative change, and supply dynamics. The market has experienced a deep washout, successfully clearing excess leverage. While Bitcoin plunged from $126,000 to below $82,200, it has staged a partial recovery, testing the $88,000 level. Critical support. For analysts, the critical technical areas to monitor are the psychological and technical support levels at $85,000 and $80,000. Maintaining these levels is essential to confirm that the market has established a definitive floor following the recent bearish acceleration. Liquidity. Snapback. When the selling ends, the pressure disappears instantly, often resulting in violent snapbacks that seem to make no sense to those who weren't paying attention to the underlying structure. The same way liquidity was drained over the last 6 to 8 weeks, it can come back just as fast. Future market stability and renewed institutional adoption are contingent upon stringent regulatory enforcement and mandatory reform. The crash exposed severe regulatory gaps. Beyond genius, while the Genius Act 2025 regulated stablecoin issuance and reserves, it neglected the systemic risks introduced by the exchange operational stack. The mechanisms, ADL, derivatives trading, Oracle integrity, that amplified the crisis, legislative focus. The clear regulatory priority moving forward must shift from basic stablecoin authorization to comprehensive legislation governing clearing, settlement, collateral requirements, and mandatory surveillance to combat manipulation tactics. Priority must be given to legislation mandating standardized collateral management and the reform of CEFI clearing practices, specifically the elimination of ADL. Exchange fixes. Exchanges like Binance have already committed to technical fixes, including incorporating the redemption price into index weights for pegged assets and implementing minimum price thresholds for stablecoin index stability. A significant mitigating factor concerning future price stability relates to the long-anticipated release of Bitcoin held by the defunct Mt. Gox exchange. The Rehabilitation Trustee officially postponed the creditor repayment deadline by another year, setting a new date of October 31st, 2026. This postponement is strategically important as it removes the immediate threat of a major supply shock. The delay ensures that approximately $4 billion worth of BTC will remain off the market for an additional year. The influx of recovered Bitcoin from long-term holders seeking liquidity could have otherwise significantly destabilized the recovery effort. The ultimate lesson of the October 2025 crash is not unique to digital assets. It is a repeat of the oldest financial mistakes, proving that human psychology, greed, panic, and the misuse of leverage is the permanent variable. The crash proves the eternal danger of confusing speculation with progress. Every generation believes it is smarter than the last until it loses everything in the same way. The entire cryptomania, from Ponzi schemes to leverage trading, is fueled by the hope that is stronger than math. The Ponzi blueprint, the rapid return environment of leveraged crypto trading mirrors the blueprint set by Charles Ponzi in 1920. Ponzi promised 50% returns in 45 days, paying old investors with new money. Today, the new money is often freshly printed fiat used as collateral, and the illusion of profits is sustained by the momentum of a market that looks like it can only go up. The madness of men. The psychological element of the crash reaffirms Sir Isaac Newton's bitter lesson from the South Sea bubble of 1720. Newton, who lost a fortune, admitted he could calculate the motions of heavenly bodies, but not the madness of men. Intelligence is no shield against market mania, and herd psychology destroyed fortunes in 1720, 1929, 2008, and again in 2025. The volatility underscores that the digital asset market is a zero-sum game when played with leverage and hype. When the dust settles, wealth moves from the uninformed to the prepared. Flight to real assets. History shows that when paper promises, or highly leveraged digital promises, fail, people seek value in assets that hold up under pressure. In the Roman Empire, when coins were debased, citizens turned to barter and land. In Weimar Germany, survivors relied on skills, gold, and tangible goods. The scarcity hedge, Bitcoin, in its long-term promise, is an answer to this historical failure. It emerged from the impulse for money that cannot be printed, censored, or inflated away. It has a hard cap of 21 million coins, a rule no central bank can debase. This quality of scarcity is the ultimate defense against the inflationary debasement inherent in all fiat systems. The crash was not an accident. It was a structural event that reveals the fragility of highly leveraged markets and the permanence of human greed. The data shows that the long-term economic case for Bitcoin is getting stronger while the price is temporarily falling. This is opportunity wearing a disguise. The long-term view. If you view Bitcoin as a long-term asset, ignore the voting machine of short-term volatility and liquidity pressure. Use these opportunities to buy at a discount. Manage risk. If you have short-term obligations or liquidity needs, manage your risk, perhaps by diversifying into assets outside of Bitcoin that produce stable yield or fixed income. Focus on structure. Do not confuse a broken seller in a broken market with a broken asset. The focus must be on fundamentals, institutional adoption, the network, and the adoption curve. The weighing machine of true value hasn't stepped on the scale yet. The voting machine of speculative pressure is just clearing out the debt. The final lesson: history is telling us that the financial system will repeat its mistakes with leverage, fraud, and policy opacity. Financial freedom depends on vigilance. Once you realize the safety you rely on is the cage, you can start building value in the real world, in skills, assets, and knowledge that no crash, no politician, and no central bank can take away. The collapse of $19 billion was the cost of clearing leverage. The question is whether you will learn from the historical pattern and be a survivor, or be crushed by the same mistake every generation makes.